Good morning, good afternoon, depending where you are. This is Buying a Small Business 101 with Mr. Ed Pendarvis. We're just going to give it a couple more minutes and then we'll go ahead and get started. See people continuing to shuffle in. Just as a quick reminder, this is being recorded, so we will send out a recording probably tomorrow morning as we get everything finalized. We'll be taking questions through chat, through the Q&A during the actual presentation itself. And then we'll save any for Ed to answer live to the end of the presentation. So use that Q&A button and go ahead and enter your questions as we proceed. And we'll get those answered either through chat. Warren Bazemore and Brenda Kraus are taking care of that, so they can answer your questions through the chat, or Ed will take care of those live after the presentation. But lots of good info to run through here. Ed, what is this? This is about our 10th time, I feel like, doing this presentation, and there's always a great response and great reviews and a lot of great information.
Wonderful opportunity to get together with folks and hopefully find out what it helps them get to their goal line of buying a business, locating it, and making sure it's the right business for them, and how to buy it right. And just share some ideas that we think and hope will be beneficial to them and to the marketplace.
Indeed. All right, well, we're right at the hour, so I'm going to go ahead and kick it off. So again, this is Buying a Small Business 101 with Mr. Ed Pendarvis. We will be recording once again, so expect a recording tomorrow morning. We'll be answering questions through Warren and Brenda will be taking your questions through the Q&A function on Zoom. And anything that will be answered live by Ed will be done after the webinar. So hang tight through this, lots of good info, and let's take it away. So I don't even know where to start with Ed, but 40 plus experience, I feel like, is an understatement. Ed essentially started this whole game of buying and selling a business. He is the founder of Sunbelt Business Brokers, and he's a member of the International Business Brokers Association inaugural Hall of Fame. And that's just a little blip of everything Ed's accomplished in this great industry of ours. I'm Adam Debussy. I'm the director of product marketing at BizBuySell. I've been with the company for 15 years and had the great pleasure of working with Ed every year that I've been here. So excited to be presenting along with him.
Adam,
As a reminder, sorry, go ahead.
I said, thank you very much. That's a good introduction.
You make it easy. So as you all know, BizBuySell, we are the marketplace to buy and sell a business. We have we have a lot of businesses for sale. And a lot of people come to BizBuySell looking for that opportunity to be independent. And, we're very appreciative of all the users and members that frequent our website. If you haven't, please do check out the BizBuySell Guide to Buying a Small Business. This was written by Ed and really is the foundation for getting started on your journey to becoming a business owner. So it's free, it's accessible on our website. The link is here at the top of this slide, but we'll also drop it in the chat and it will be included in the email that we'll send after the conclusion of this presentation. We also have a lot of great resources. We have a learning center where you can see articles and videos on buying a business, as well as the guide and other tools. We have valuation tools. So if you find a business you're interested in, you can quickly get an estimate of what that business may be worth. And last but not least, we have our quarterly insight report. So we're in the process of conducting that right now, and that should be ready by the 15th of next month. And we email that out to all of our email subscribers. So if you're not opted in to receive email from BizBuySell, please take advantage of that. And last but not least, if you're ever in need of help, we have a broker directory where you can find an expert near you that can assist you with your journey. But of course, you also have Ed as a resource, and he is available 24/7. I kid you not. And we're going to give you a few options of contacting Ed, either through email or setting up a meeting directly with him as this presentation progresses. And with that, I will hand it off to you, Mr. Ed.
Thank you very much, Adam. Great to be back with you. I sold Moses his first herd of goats a long time ago, and he stiffed me on the commission. That's why I went to the International Business Brokers Association to learn how to list and sell business, but get paid when you do. It's good to be with you today. There's a lot of things going on, a lot of opportunity for this year in particular and coming into this new year to go into business for yourself and look at the options that that provides for you and perhaps have a job for life in that business and build it up. You've got something to sell when you go to retire, or you'll leave it to your family and things. That's a family business. And that's what we're going to be talking about today is how best to locate and buy a business that works for you. And I appreciate the opportunity of you being here. And certainly appreciate Adam's help and Brenda Krause and Bob Holt. Bob House has been a wonderful help to us, and Warren Breesmore over here. I appreciate their help in bringing this to you, and they're also constantly are working to help the marketplace produce opportunity for buyers and sellers. Buying an existing business usually already has trained employees, a customer base and cash flow, and a proven track record of success for however many years it's been open. And as opposed to a startup, that usually gives you a real good head start on knowing what's going to happen based on what has happened with that business. And we'll show you how to look at that and interpret it the right way. Adam, if you will just go one slide from. Let's kind of define our marketplace that we're talking about so we're all on the same sheet of music, you might say. It's kind of funny. 98% of the businesses in America are mom and pop small businesses. Yet all of the education you have in colleges and universities on business is on big business, publicly traded companies, stock market companies. I call those Wall Street rules, and we're going to be talking about that a little bit. Small business runs by what I call Main Street rules. I like sports analogies, so I say big business is like football rules, and small business like baseball rules. They're both a ball game, but sure is a different set of rules. And that's what we're going to talk about a little bit now to get you comfortable with baseball rules and understanding where you're coming from with that so you can evaluate an opportunity correctly and to your advantage. All right, publicly traded company, that's what I call a stock market company, of course. The biggest difference, though, besides the size of the company, is that the way they make money. You take Coca-Cola, a wonderful company, of course, but they make money by selling their product or service all over the country, all over the world. They also make money by selling corporate shares of stock, equities in their company and in their business. And so you've got, let's say, the billions of dollars that they do in selling stock from around the world. But then you add to that, they sell 30,000, 30 million shares of stock or 3 million, whatever the number is. That's a whole barrel of money that comes into a publicly traded company that's not available to a small business. A small business only has one way of making money, and that's the sales of their product and service. Every now and then I'll mention some. I'll ask you to write that down. This is the first one. If you don't mind, write this down. Sales drives value. Sales drives value. If there's no sales, there's no value. It doesn't matter how much equipment you got or inventory you got and things. Sales of the market's response, that business's market responds to that business's product or service. And so that's a very important number that we're going to be dealing with all the way through the opportunity to evaluate a business opportunity for you. In financial terms, a big business may do billions of dollars in sales. The average small business, Main Street business, does $1 million in sales, maybe $1.5 million up to $2 million. It got about 20 employees or less, but it makes a good living for the family that owns it. And so there's a huge difference in the income stream based on that. Now, I'll tell you something interesting. Bigger businesses, 62% of them don't pay any taxes because they don't show a profit for tax purposes. Taxes are going to impact some of our decision making going forward. I mentioned that just for now, so we bring it back up later. When I'm looking at a small business, I'm looking at the product or service that they sell, the number of employees they got, and when I'm looking at their records, I'm going to put them in the proper context. There are three levels of accounting that we deal with in evaluating businesses. Big business, public traded company, has an audited statement. In other words, the audited accounting firm states their reputation and signs off on that. It's audited. We are convinced this is the proper portrayal of the value of this business opportunity over the course of this, usually a 1 year period. The second area of value of the business is reviewed statements. So you got audited statements. Big companies do reviewed statements. Something we deal in small business with Main Street business with compiled statements. Jokingly, compiled is here's all my stuff. I put it in the shoebox and I took it down to my accountant, and he filed my tax return. He didn't check my sales. He didn't verify them. He didn't take an inventory. He doesn't do any of the normal things you do to audit or provide an audit or reviewed statement. So it's called a compiled statement, and he'll have a disclaimer on the front of that financial and tax return that says all of the information has been provided by management, and management has chosen not to use any of the normal things required for GAAP financing, generally accepted practices. So unlike the bigger company that has an audit statement, all of this information has been provided to the accountant, and he never left his office. His review is simple as he puts together what he needs to file the tax return. And most of the time, the thing that the seller of the business, owner of the business, and the accountant's working on is how to minimize taxes. And you pay profit on taxes. No profit, no taxes. And so sometimes the very way that they do their accounting works counter to us trying to find an acceptable value and the real value of that business. That's the reason we're having this seminar. One of the reasons is to help you understand the financial situation just a little bit. Next slide, please, Adam. Where to search for a business for sale. Now, because of confidentiality, this is probably one of the two biggest differences between us and real estate. In the real estate business, you got something for sale. You put a sign out in the yard, you put balloons out, you want the world to know it's for sale. In a business, you don't want anybody to know it's for sale. You don't want the employees to know it, customers, competitors, landlord, bank, anybody, until it's the appropriate time in the process that they would know. So we deal with a confidentiality that is critical as far as marketing the business. And so how you going to find a business for sale? You ride all over town. You're not going to find a sign in the window saying business for sale because of confidentiality. The second thing that's a huge difference between us and real estate is in real estate, there's no relationship between the buyer and the seller. You and your wife or you and your husband look at a house, several houses, you see one you like, you make an offer on it. You don't even meet the seller because they got nothing to do with it. You're just buying property. You might meet them at closing, but if you do, you'll never see them again after closing. In our business, one of the first things I want to do is I want my buyer and seller to meet each other. I'm going to encourage my buyer to let's go see the business, not just the financial information. We'll get that too as part of the due diligence process. But let's go see the business, because guess what? If you don't like it, you're not going to buy it. If you do like it, we might see if there's a way to work it out that works for you and works there. There's a great company called This Just Lunch. I wish I'd invented that business a long time ago. Not much money invested. We just meet each other. We either like each other or we don't. And if you do like each other, you want to go out again or maybe go to supper. If not, I'll never see you again. And we had a nice lunch. And that's the same way I would recommend you do in looking at a business to some extent. Go see the business. See if it's something that you're interested in and would work for you and you'd be proud to own. And you could see yourself working in that business and building it up to provide a living for you and your family, just like it's provided a living for the seller and their family up to now. Next slide, please, Adam. These are filters. There are different things there. Some of these apply to you, some will not. But also take an honest assessment of yourself. What are you looking for? Are you looking for a franchise or a non-franchise? A business already up and running? Are you looking for a business that you can run yourself and things from there? And by information from the seller, and taking a look at it, meet with the seller maybe after hours or on the weekend with the broker. Most businesses are listed by a broker, and that's good, not bad, because that broker can help you an awful lot assemble the information you need and realistically look at the business and apprise it of value and have an opportunity to buy it if it is something you want to buy. Now, let me tell you, the uh, the buyer actually is working with the broker. The broker actually legally works for the seller. They're fiduciary relationship, legal relationship with the seller, but they sure don't work against the buyer. Quite frankly, I spend more time probably with the buyer than I do the seller, helping them come along and understand the business and understand the opportunity value that business fits there. And does it fit a lifestyle that fits for you? So you do kind of an assessment of yourself. I always say look in the mirror and put a thing together a little bit about what you're looking for to provide a living for yourself and your family going forward, particularly in today's world. Next slide, please, Adam. This is just some things you run into that you might not run into, certainly looking at real estate and things. They'll ask you to sign a non-disclosure agreement just to hold information in confidence. Then you're asking somebody to show you their tax return and financial information and confidential information, and that's fine. They want you to hold that information in confidence and only use it for the opportunity to buy the business if you're interested. And you may end up looking at 2 or 3 businesses or 4 or more before you find the right business. Nothing wrong with that. Just like you date different girls or boys in high school and college before you find the right one. And you're going to do the same thing with a business. Spend some time looking at businesses and see if you find something that you feel would work for you and that you can buy based on the information from there. Next slide, please. Evaluating a business for sale. Now, we'll send out a list of this information so you'll get a copy of all this to you so you don't have to worry about writing so many notes and things, but every now and then I will ask you to write something down. All right, evaluating a business for sale. Let's see if we see something that we like. What do we want to do to take the next step? Next slide, please, Adam. All right, so here's some other filters. One question I always ask, and I always want my buyer to ask, is why are you selling? If this is such a good business, how come it's for sale? Now, I will tell you, most businesses sell not for financial reasons, they sell for human reasons. The owner dies, the owner's getting a divorce, the owner's relocating, they're retiring, mama's ill, we might move back to Indianapolis and take care of her. Something has come up in the owner's life that now that business is making them a living becomes something they want to sell because they're going to do something else or some changes about it now. But I always ask that. If they're such a good business, how come you sell it? And I want to feel comfortable with that. Ask the seller how he's compensated with the business. The biggest thing you want to do is you want to know what that business's income producing is because what you're buying when you buy a business, you're buying income. You're buying the actual cash flow of the business, and that's we want to see how it's doing now so we can figure on the base of what we're going to do with it going forward. Is the owner taking out a salary or W-2 earnings, or the wife's car, his car, trips they take, health insurance, life insurance, different condo at the beach, kind of thing. Anything that the business is running through the business and the business is providing for the lifestyle of the owner is legitimate to add back as potential cash flow so that we can find out what the earnings of the business are. Now, sometimes the circumstances out of the owner's control is making a difference. I was making this the other day, talking to my wife, Elaine, and there are 3 things that are impacting our world with small business, big business too, but particularly small business, that we don't have a definition for yet. One of them certainly is what we're doing right now with with using the opportunity to be. I think Alan is in San Francisco. I'm in Charleston, South Carolina, and Zoom technology has made available a whole nother level of information available both to buy and sell on things. So Zoom is impacting us. It's one of three things I think that impact us big time. Second is artificial intelligence. We don't know where all that's going, but there's no question it's going to impact almost every business in some way, and hopefully in mostly in positive ways. And the third area, though, is Amazon. Amazon has changed the way the world shops. I don't think my wife and I have been in a department store in 2 years. She orders things on the phone there and it's at the front door the next day. That's a huge change in almost every business impact there, and we don't know what that impact is yet. We'll have to see, but hopefully mostly positive. Next slide, please, Adam. There we go. Um, what are your most valuable resources? Sometimes not money. It may be the employees of a business, depending on what the situation is. But you've got trained employees and a customer base already proven itself. You've got a income based on at least the last 3 years of records of the business of stock, both information you'd have on it, both from recording tax returns and perhaps P&Ls and bank statements, or whatever else we need to do to learn the cash flow of the business. At the same time, what's the nature of your customer base? You think it's pretty sure you can hold on to that? And who are your major competitors? And how is the business overall positioned in your community? All of that is going to impact your opinion of value and what will work for you. Next slide, please, Adam. Business usually in existing businesses got positive information, competitive products, established customer base. That's a biggie, very important. Recurring revenue. If it's a business that has that, that's good. You don't have to start with a new sale each time. Growing market and industry, diversified customers and suppliers, a steady year-round sales, easy transfer to a new owner. And on top of that, like I say, is artificial intelligence. What changes that might be to pretend for that business. What's the Amazon effect is it? And the opportunity there just to look at the base of information on the business there and figure that into your decision if it works for you. Next slide, please, Alan. 3 main areas of focus. A lot of times folks ask me, what's the main thing to do? And almost in university, somebody said, find out what the bottom line is. No, let me suggest this. Here's a way I think you'll find will be more beneficial to you. Because the bottom line is done to pay no taxes. It's not necessarily a portrayal, an accurate portrayal of the earnings of the business. So number one, focus on the business itself. In other words, if you don't like the business, you're not going to buy it. Man, I don't think it'd be anything worse than hate to get up and go to work every day. So if you got a business or something that you like to do, then it's a lot better an opportunity that you can be successful there. You ever see a doctor, a lawyer, a business person, a singer, entertainer, if they seem to like what they're doing, if they're successful, don't you think so? Now, do you think they started liking what they were doing and then were successful, or do you think they became successful and then started liking what they're doing? I think that they liked what they were doing while they were making it successful, and they could put the time and energy and effort in that to make it successful. So focus on the business if it's something that would work for you. Then when you do focus on the financials, which certainly you will at some point in this process, look at the top line, not the bottom line. The top line tells me the trend of sales, gross sales, and that's a hugely important number. And that trend of sales is also, obviously, you'd like a business to be trending up in sales. If it is trending down, we need to ask the seller why he thinks that is and how it's going to impact you going forward. But you want to look at the top line of the financials. And here's a pretty good rule of thumb. Most any Main Street business will throw off to the owner somewhere between 10 and 20% of its gross sales. And that's a pretty good rule of thumb. I'll show you that in just a minute. And then the third area of focus, which is critical, I call it 70% of the decision-making process. It's what you're going to do with this business after you buy it. In other words, you can't change what the seller's done with this business for the last 10, 15 years. You can't change that a nickel. What you can change is what you're going to do with it after you bought it. Years ago, about 40 years ago, when I bought the other folks out of Sunbelt, which was one office in Charleston, South Carolina, it was losing money. It wasn't losing money for tax purposes, it was really losing money. But I had an opportunity to buy them out with terms and conditions that worked for me, and they were already in business. They had an ad in the Yellow Pages, which was the original search engine. Back then, if you weren't in the Yellow Pages, you weren't in business for a year. And so they were already in the Yellow Pages, already had a location, a couple of brokers semi-trained, and I saw a value of buying them out. And in my opinion, I paid them way too much for the direct value. But I had an ongoing business that I could build on, and that worked out well for me, with a lot of hard work and the Lord's blessings over the years. Next slide, Adam, please. So one of the biggest thing we want to know, very important question, how much money can I make by this business? Well, to start with, you're going, what's the seller doing now? Because I'm assuming the seller knows the business. They've been successful in it to the point at least they've made a living for X number of years. And based on that experience factor, I want to see what I think the estimated benefit, owner's benefit is. Now, some people call that the seller's discretionary earnings, seller's discretionary cash flow. I usually call it just owner's benefit. In other words, what does the owner totally benefit from owning this business? And I'm going to subtract from that what would be the debt service of the acquisitions that I buy it, so I'm going to owe money back to the bank or to the seller. Then plus, very important, what you're going to do to improve the business. Don't leave that out. That's the whole thing that you're going to bring to the table after you close. And what are you going to do to drive value and drive up the value of that business? And I'll tell you, most of the time, a new owner will jump a business 15, 20% the first year. You know why? Enthusiasm. They open up earlier and stay open later, paint the place, clean it up, do better by the customers and by the employees, encourage and incentivize the employees. And guess what? The business gets better. New enthusiasm and new energy almost always does the value. Let's look at when I say 10 to 20%, you say, where do you get that? Let me show you where I get that. Here's an example of kind of a restaurant business, kind of universal as far as these general numbers are concerned. But let's see if we got a restaurant that's got gross sales of $1 million. All right? Well, the restaurant business, universally, 28 to 32% of the business is food cost. So let's just say 30%. And then another 28 to 32% is labor cost. I don't care how much business you do, and you got those two issues right there. Then another area of expense is rent cost to be there. Usually that's about another 10%. And then you've also got administrative expenses, about 10%. That's insurance, advertising, electric bill, refuse pickup, and different things like that. So you add those up. Here's $1 million less 300,000, less 300, 600,000, 700,000, 800,000. What's available to the owner after he's paid the expenses all the way through and employees and things is somewhere between 10 and 20% of your gross sales. So if you do more sales, you're still going to have those ratios for both the food cost and labor cost. All right, so that's a pretty good rule of thumb. Anybody tells you they're making more than 20% on the business, they're going to have to show me that because normally the margins and competition and things like that would keep those numbers kind of in place there. All right, Adam, next slide, please. All right, and this is kind of an official ad back. You use this phrase a lot when you're dealing with business brokerage community. What are the owner's benefits, seller's discretionary earnings? They add back after they've taken them out on the financials. And here's what we're talking about there. When you got your gross revenue, gross sales, less your expenses, cost of goods sold and things from there, all of those costs go out from there, leaving you a net profit, or hopefully a net profit, or loss, but usually a profit or loss on your P&L. Well, then you can add back to that number discretionary personal expenses. In other words, you expense them out, you can add them back because that was the owner's benefit. You didn't have to take that trip to Las Vegas to the convention and then also to the Grand Canyon for you and your family, but you did, and you wrote it all off as expenses. You've got non-operating expenses that are coming that are not recurring. I had to put a new roof on part of my office this year. I think it's $15,000. We just expense that out rather than putting it and amortize it over real estate. Now that won't happen again, I hope, for another 20 years. So, but I'm going to add that back as far as cash flow because that's a one-time expense that wouldn't happen on the next year. And then depreciation and amortization. International Business Brokers Association rules allow you to add back depreciation and amortization. Those are non-cash expenses. In other words, that's a tax situation, not an action. There's no cost to those. So you can add that back there. That would give you, when you add those up, the seller's discretionary earnings, or as I call it, owner's benefit. That's an important multiple when it comes to value. Next slide, please, Adam. So here's the way you'd work with that. There are two ways to approach value in a small business, a Main Street business. And you might want to write these down just from that. Well, here's one of them right here. But the other one is some percentage of gross sales. Gross sales, like I said, sales drive value. So some businesses will sell for 60% of gross sales, 50% of gross sales, 80% of gross sales. Based on business by sale, you can see what other businesses are doing percentage-wise. The other way of making a valuation of a business is this right here, is some multiple of earnings. So if you're looking at this example we had, the seller's discretionary earnings on the business there, let's just say was $200,000, then multiply that times your earnings multiple for that type of business. That equals your estimated value. Now, I'll also tell you this, because we do, at the International Business Broker Association, we do educational seminars on pricing of businesses. And I'm certified with that 2001 course, 2002. But after 2 days of formulas, it comes back to the fact of guess what? For the last 15 years, the average selling price of business is somewhere between 2.2 and 2.5% of multiple of earnings. So if you were to use that in that formula you got, $200,000 times multiple of earnings, that would give you the estimated value. And also rest of the businesses usually sell for around 35 to 50% of gross sales, depending on that. Next slide, please, Adam. Then other factors could influence value, certainly. An all-cash sale, if you're going to pay somebody all cash, buyers run the entire risk. That might be a lower cost. High interest can cause problems. I'm glad to see the Federal Reserve finally is taking the interest rate down a little bit. I think it'd be helpful to everybody if they would do that. Higher sale prices, you get a seller finance sale. Oftentimes, we'll be talking about this a little further down, the price is more important many times to the seller. Terms and conditions are more important to the buyer. In other words, I'll pay you $400,000 for this hardware store if you'll take $100,000 down, because that's how much I can write a check for and still have a little working capital, and you finance the balance of $300,000. So terms and conditions are critical to the buyer. From the seller's standpoint, we'll have to see what terms and conditions we can work out that work for that the buyer is capable of doing. It's also acceptable to the seller. Most of the time, the seller wants all cash. Let's start with that. Here's the problem with that. Americans, we're not big savers. We make $100,000 a year, we spend $110,000. We make $200,000 a year, we spend $210,000. We save $210,000. If we ever make $300,000 a year, we become a Republican. And Republicans can always save money. So if anybody's got $300,000, they can buy most any business we got. So oftentimes, though, the down payment range of most buyers is going to be $50,000 to $150,000 that they can write a check for out of savings. and still have some working capital and ability to do this. And then somebody's got to finance the balance, either a bank with an SBA guarantee loan or the seller. And many times it's going to be the seller, at least partially. We'll talk about that. Next slide, please, Adam. Making an offer and negotiating a sale. I will tell you, Americans are not good negotiators. We're terrible at negotiating. We don't like to negotiate. Every time they take a survey about what folks don't like about buying an automobile, you know what number one is? The hassle of negotiations. Americans don't like to negotiate. And buying a business, you have to negotiate to get a fair deal. Next slide, please, Adam. Now, when it comes to making an offer, after you've seen the business, of course, and working with, and my suggestion is, I'm going to come back to this, take advantage of the broker. That business broker has educational and professional certification and experience factor of putting deals together that work for both buyer and seller. If a deal doesn't work for both buyer and seller, it's probably not going to work. This should not be an adversarial business. In other words, the seller wants and needs to sell, and the buyer wants and needs to buy. So let's see if we can put a deal together that makes sense and works for both of them. And I always start with this premise. I'm not dealing with a foolish buyer, and I'm not dealing with a foolish seller. Before it's over, hopefully, we can work out something that would work for both of them and accomplish getting them to their goal line of owning a business. And you know what? It's the same goal line. It's the same goal line. When a seller sells a business, a buyer just bought a business. And it works for both of them based on what's going on in their life. The buyer, the seller probably is more concerned with the overall price, and oftentimes the buyer is more concerned with terms and conditions. You can't write a check for a down payment more than you got unless you can get a loan from somewhere. Many times that's going to be the seller. But when that buyer does write that check, they are heavily invested in the future success of the business. And they need training and transitioning from the seller, and they need the opportunity to continue that successful business so make a living for them and their family going forward. In terms and conditions, everything is negotiable. You get closing, you could start note payment 90 days after closing instead of 30 days after closing. It gives the new buyer an opportunity to recapture some of his cash flow and working capital if he needs to. But everything is negotiable, and that business broker can help you put a deal together that works for you. And so take advantage of the professional business broker, and you'll find a list of all of those folks on Biz by Sale. Great opportunity with a huge amount of professional talent there waiting to help you honestly. Next slide, please, Adam. Making an offer to buy a business. Once we've seen the business, not surprisingly, many times the seller is asking more for the business than the buyer thinks it's worth, or that the buyer can pay or borrow. So to get to that magic number in terms and conditions of a deal that works, you need to somebody needs to get it off center. Sometimes I'll have a buyer say, well, he's asking too much. I said, well, what do you think it's worth based on what we've seen here? Let's assume it's making what he says he's making. You look at how you'd run the business. What do you think you could put down on the business and make an offer based on that? And the down payment is a critical issue. And write that down just a minute. Down payment is a critical issue. If you can buy a business, and I'll show you this number-wise, if you can buy a business that you can put down $100,000 and you can make $100,000 a year and the business carry debt service, that's more than 100% return on your money. If you can put down $80,000 and maybe buy a business that makes you at least $80,000 a year plus numbers, put down 150, make 150. I try to end up on a deal that I'm working with a one-on-one number, 1 equals 1. Put down 100, you can make 100. Like I say, that's 100% return on your money. Where else can you get 100% return on your money? And an opportunity to build a bigger business based on that base that you're buying and going forward. Next slide, please, Adam. So here's an offer to purchase with price, terms, and conditions. Now, I'm not going to read all of those, but you'll have a list of them from here. I usually suggest $1,000 refundable deposit with an offer, and based on terms and conditions initially that absolutely work for the buyer. So if the seller does take this, the buyer is in a position to perform and buy the business. If the not surprising, the seller may not take the first offer, but at least it's an offer in writing and invites him, particularly if he's working with a business broker, it invites them to come back with a counter offer that the seller will take that may be accommodating for some of the big points with the buyer. Now, any offer that you make protects you with these terms and conditions. All financials are subject to review and approval by the buyer. That's a walk as big as a barn door for the buyer. These terms and conditions are attested to and approved by the buyer. Lease is always a problem. Every now and then I'll have one of my brokers say, I don't think the lease will be a problem. The only thing I know is he ain't talked to the landlord yet. Lease is always a problem. They always want to go up, they want more. And so our job is to work that out between that and the new buyer and the seller so that we can do a lease transfer that's acceptable to everybody. Equipment's in good working order. We'll check that out before closing. Saleable inventory is at normal level at closing. We'll verify that and actually take inventory before closing. Every now and then you'll have some inventory. You heard of LIFO, FIFO, first in, first out. Sometimes you got fish inventory too. First in, still here. So we want to make sure that we're getting a good information on that inventory and it's all sellable items, or we assess a little bit lower price on part of it. Buyer seller agree on acceptable industry non-compete agreement. That's part of the deal. And we need a training and transition period from the seller for at least 30 days. We usually do 2 weeks full time, 2 weeks on call for a smaller business. If it's a little more complicated, you might do 60 days. But what we usually do after 30 days, we arrange some compensation package for the seller who has to come back in to help the buyer going forward. And we try to help work that out where it works for everybody. Next slide, please, Evan. It'll end up, and you'll see this oftentimes, that about a third of a business is somewhere the buyer comes to the table with that. Seller financing is about a third, whether he wants to or not before it's over, have to. And bank resources, SBA loan, about a third. Those numbers will vary just a little bit. We'll try to get as much money as we can from an SBA loan. They'll usually finance business acquisition for 7 to 10 years. If there's real estate property with the deal, they might can do the financing for up to 25 years. That can make a huge difference in the monthly payment obligation of the business going forward and can affect the working capital necessary to make the business work. And like I say, you're going to need some working capital after your down payment and acquiring the business. Next slide, please, Adam. Pros for buyers and pros for sellers. I'll leave this kind of review. Each of these items can add some value to both the seller and the buyer. And oftentimes, adjusting some of these as a broker, we can end up accommodating a concern of either the buyer or seller that allows us to go ahead and go through closing. And the buyer take over a business, hopefully, that'll make a living for them and their family for years and years. We'll see. All right, next slide, please, Adam. Due diligence and closing on the sale. All right, let's talk about that just a minute. Next slide, please, Adam. Rule of thumb in final due diligence. This is probably where you want to get an accountant involved, or perhaps an attorney, certainly, or an escrow agency that helps close the deal. I always like to try to put a deal together with the broker before we turn it over to an accountant or an attorney. Now, the reason is, of course, the attorney would normally do the closing and things for that. In California, they use escrow agencies, but most other places use attorney. And we try to use a common attorney if we can. It serves in an escrow capacity. They don't represent the seller, they don't represent the buyer. A little bit bigger business, we'll have an attorney for buyer, an attorney for the seller. But as best I can, I want to keep this from being an adversarial transaction. And we try to stay involved as a broker so we can get the attorney whatever they need or the accountant whatever they need and provide, try to put together the information to get a loan to acquire the business properly. Buyer will also want to review and verify the financials. You can do that by getting P&Ls, tax return, expected tax return, not to be pretty, adjustments, gross sales, seller discretion earnings, inventory at normal level, equipment in working order, in-place earnings and obligations, customer mix. We'll feel comfortable we can keep that customer base, operations management, corporate documents, lease transfers acceptable, industry non-compete, and training and transition. All of those things will be done for you and can be helped with a business broker, and I certainly recommend that you do that. If not, certainly before you close, you would want an attorney and accountant to look at your opportunity. And if I can be of any help to you with that, give us a call. We'd be glad to look at that too. Next slide, please, Adam. All right, this this is a business I sold 3 to 4 times over the years. This is probably a classic example of what I'm talking about a tax return. And I include this in there. If you'll follow me along with this just a minute. This is a sub S corporation for a small business. It was a beer and wine discount store years ago when people used to go there rather than go to the grocery store to buy beer and wine for parties and things like that. The business did a little over $1 million in sales. What is that? A million two? What is it? 848. And look at the bottom line. It lost $6,500. No, it didn't. It lost $6,500 for tax purposes. This business was cash flowing to the owner a little over $100,000 a year. All right, now let me show you what that is. Look at the top line. A little over $1 million, 10 to 20% you can normally make. And what had happened, the lady bought this business, a discount beer and wine store, and right at first, when she first bought it, she was there all the time. Then she got remarried and she was going a lot. And when she wasn't there, her employees, unfortunately, was really taking her to the cleaners. And when, even to the point she was constantly overdrawing her account. And sure enough, the last year she was in business, she had over $10,000 non-sufficient charges, just bad management. And so she also had a Corvette automobile that was being paid for by the business, convertible. His son had a CJ7 Jeep. He couldn't sell beers, wasn't old enough, but he could deliver it and put ice on it, things like that at the beach, and then pick up the kegs on the weekend. And so, good little family business. One guy told me she finally kept overdrawing her account. Her accountant recommended she hire an underground detective, which she did. Unfortunately, had 2 kids arrested, both of them college kids. One of them lived right down the street. One of them had about 20,000 in savings in the same bank she used. The other one had almost 10. I bet they ended up being the head of Enron or something like that later. But sure enough, they were arrested. So there was a provable cash flow there of $30,000 taken out of the business that should have been hers. The other thing, if you notice, is a thin margin. Meaning the cost of goods sold. Now, what that would indicate to me, I always run this, is she's not reporting all of her sales. Now, whatever she deposits in the bank goes into the checkbook, and checkbook accounting is income. If she has cash that she doesn't deposit in the bank, that doesn't show up there. But I'm not counting that into $100,000. But based on that story, let me show you what to do. All right, you add back her salary, which was $30,600. She's the only officer. Add back the depreciation. You add back the interest. You got there $12,000 depreciation. Add back the automobile, about $400 a month for her car, $300 a month for the son's car, $2,000 a year for insurance and things on the automobiles, and the overdraft of account was just bad management. You add those expenses back in, that adds up to over $100,000 in owner's benefit. But as far as the numbers are concerned, it ended up with $6,000 profit. Well, guess what? It's a sub-S corporation, so she got $30,000 less 6,000 on the profit and loss. She was paying taxes on $24,000 a year. The business was providing her $100,000 in cash flow, and she was paying taxes on $6,500 legally. Excuse me, she paying taxes on 6,000 from the 24. So that was a good cash flow business, but you had to be there. If you weren't there, the people, employees, unfortunately, had an opportunity, all cash business, just about, to be a partner you didn't know you had. We sold that for $190,000 with 90 down. She financed 100,000, and we were able to sell it to somebody else. And she told very emphatically, "You got to be here. These people steal you blind." And so she warned them about that, and he was aware to do that. All right. Next slide, please, Adam. Rule of thumb: reps and warranties from the seller. We're going to, and your lawyer will help you with this as well as your business broker. We're going to expect to get the warranties and representations of the seller true and accurate, and they put their money where their mouth is, particularly if they do some owner financing. You can feel comfortable what they're telling you about the truth because you're going to find that out as soon as you get in there. But you want to find that, standpoint, that your reps and warranties are going to survive closing. In other words, it's not over at closing. When you get in there the next day and everything they told you hopefully is going to prove to be accurate and correct for both you and them. Next slide, please, Adam. This is some differences between existing businesses and franchise opportunities. Of course, with an existing business, you can kind of run it like you want to. Franchise, you got to do it the way the franchise wants to do. And if the franchise does well, you'll do well. In some cases, if the franchise doesn't do well, that's going to be a hard time to work from there. So you need to evaluate that opportunity just like you would an individual business. All right. And now I will say this: a franchise has to have an audited financial statement, so you can count on the financial statements to be more complete and accurate with a franchise. Next slide, please, Adam. Who's that fellow? All right, learn more about the value and process of buying an existing business. Now, we got books and videos and opportunity to talk with me one on one or in a group, as we'll see. We're probably plowing some new ground here. We want to be able to help more buyers find the right business for them. And I'm going to steer you very comfortably to the business brokerage community because anybody that's part of certainly the Sun Belt, but Transworld, the VR business brokers, Murphy, all of those have additional training in addition to the IBBA, where most folks are members. So you can feel comfortable with how they should help you locate the business and hopefully put a deal together that works for you and your family. But anything we can do to help you, please give us a call. We're right here with that, and we look forward to working with Adam going forward. Get in touch with them or us, we'll follow up with it. Thank you so much. I appreciate the opportunity. We'll take some questions, I think, Adam.
Yep. Thanks so much, Ed. Just so much information, valuable information that you shared. And just to reiterate, Ed is always available. So give him a call, shoot him an email or book a meeting, and he'll be happy to help you. So yeah, got some good questions here. So I'm going to kick it off with the first one. Case asks, is it customary to require an LOI before releasing financial statements?
It's not custom, but certainly the broker is going to encourage that. And from a buyer standpoint, they want to do that because they want to know you're qualified and capable of making that offer based on that. So it's not uncommon, just like the buyer wants information from the seller. The seller wants a little bit of information from the buyer, particularly if they're looking for some owner financing. And usually I try to present that in the best light to both sides as far as looking at the numbers and things from there.
Thanks, Ed. So we have another one here. So when you said that the earnings SDE is 10 to 20% after gross sales, are taxes included in that?
Yes. In other words, well, now you got several layers of taxes. Of course, you got state taxes, you got tax on certain items and things there. Then you got taxes based on profits, and of course that's what we're looking at as the P&Ls that were turned into the accountant. and the numbers are no better or no worse than if these folks keep their records. What you'll find is the accountant, like I say, he doesn't question the numbers. The people who compile it, turn the numbers into him. He doesn't check the inventory. He doesn't verify the sales. He doesn't. They just take those information and put together what's necessary for tax purposes, and they look for ways to legitimately reduce tax burden, whether it's accelerated depreciation, investment tax credit, different things that we could do that would mitigate the taxable obligation of the operation of the business. And so that's one of the reasons I caution people is that sometimes folks are real aggressive and they'll get the tax return, and to get the tax return, they never even go see the business because they stop right there and say, well, I don't see where the profit is and things. Well, they spent a lot of money so you don't see where the profit is. Yeah, so right or wrong, ask the seller's information and ask the seller to show you where the money is. That's a very legitimate question if you're going to spend your life savings in buying that business. That's a joint effort. But don't be surprised if the seller or the broker does want some information from the buyer also as far as the seller. Um, I try to get the buyer seller to have a meeting before we give them the tax returns and things. I give them the financial information, not the financials. In other words, gross sales for the last 3 to 5 years, something like that. Um, and basically what the seller says he's making. Here's the way I ask that question, Adam. I'm sitting here talking to the seller, and we can go into the business. So about how much did you do last year in gross sales? Sellers always know that number. And so the 620,000, whatever that number is, 892,000, something there. I said, well, let me ask you something, Mr. Seller. If somebody came in and bought this business, now they don't know as much about it as you do, certainly, but let's say you taught them how to do it, and they did about 620,000, whatever that number is. How much do you think they could make here a year? Now, what I just asked you, how much can I make if I did the same amount of sales you're doing now? I'd like for him to answer that question, and I'd like for him to show me where that money is, based on walking back through the financials with them and showing me where the opportunities are, where the add backs are, and things there that we can legitimately show as earnings for the business. And I'm not trying to discount that. I'm trying to find the reasons that I can make that acquisition work and also get financing necessarily on that from that. But it's not unusual that they'll ask for more information. Everybody wants more information. I normally just say, Mr. Seller, Mr. Buyer, sellers ask us not to show anybody the actual tax return until they've met them. You can understand that. Let's go meet with him. Let him show you that and answer any questions you got on the business. I consider a buyer seller meeting a great opportunity to ask any kind of questions you want to get information on you because you're really getting ready to risk your life savings in buying that business. You deserve to an answer, an honest answer, and complete answer to those questions.
And I have a great follow-up from Albert. He asks, are there any tips on determining the real reason why a business is for sale? I see that typically the reason is retirement. Is that true? And
If
if
he's
not, how do you
26,
get to it?
if he's 26 years old and he's looking to retire, that's something else.
Yeah.
We're oftentimes retirement, but as you get to know it, usually things will come out just a little bit. And that's part of the due diligence process. It's just like dating. Like I say, the first time you may go to lunch, then you go to supper, then you get to go to a movie, then you get to know each other a little bit better and things like that. The relationship progresses. I look at a business transaction as kind of the same process. The relationship's going to progress, hopefully to a successful outcome for both buyer and seller. And we start off, we are miles apart. The seller wants 500,000 all cash. Buyer's got $100,000. He can't write you a check for $500,000. We got to figure out a way to get there. And oftentimes in getting bank financing, all of the information has got to be presented to the bank, of course, and they do their due diligence on that too. And in doing that, most of your questions are answered on the way through due diligence to closing.
Thanks, Ed. Okay, Sean's asking, are there good starter businesses to buy, i.e. a car wash or laundromat, something of that nature?
If you got a pretty good location for that and a good lease, those can be kind of steady, recurring revenue type things, and hopefully you'd have section there that you'd have some room between the competitors. Got a little bit of room there. A lot of folks look like a coin-operated laundry and a car wash are not quite as management intensive. That's so to some extent, but I'd rather have an opportunity maybe the business I can grow beyond that with proper management. And I'm not sure you can influence those too much one way or the other. We'll see.
Thanks, Ed. We're running up on the top of the hour, but let's try and get in as many questions as we can here. So we have, is it normal to buy the inventory that a company has in addition to the asking price of the business itself?
Depends on the business just a little bit. Oftentimes on inventory is a separate number in a convenience store because it can vary a good bit there. Particularly if it's dropped gas, gas is a separate item there. Then the inside inventory. A liquor store, some of that inventory is critical. The other businesses, the inventory is a service business more related there. The inventory is not as critical as long as you got good equipment in working order and things there, and you've got the necessary inventory to manage the business for a while. Usually, you just want what we try to shoot for is when we take inventory the night before closing the next and close up the next day, that business is ready to open for business. Normal level of inventory, trained employees, customer base. As far as the world is concerned, we're the same business until we transfer it properly.
Excellent. Okay, so the next question, where do you find comps for businesses sold that are similar to the business you want to purchase? Obviously, Biz by Sell has a valuation report that we offer. We also have Biz by Sell Edge, which is a more premium membership for buyers that gives you access to free valuation reports. So that's one resource. Ed, are there others that you could recommend?
That edge is probably the top of the draw right there. Listen, Biz by Sell's got so much information available to it. It works for brokers also too, as far as buyers and sellers. But also that the Edge program, you constantly give you updates on things, and you need that information so you can make the right decision for yourself and your family. And of course, the first decision to make: are you going into business for yourself? And you say, yes, I am. Okay, then by George, let's get after it. And use the resources that are available, actually at no cost to you, basically, from Biz by Sell, or contact the broker that you're comfortable working with and let them see if they can find your business based on what they have in inventory or businesses for sale and what they may know of business that you can find for you.
Okay, so here's a question about funding. Are there funding sources outside of the SBA that might look at the business only and not attach a lien to personal residence?
In most cases, we try to stop the liability of the security with the business itself where that's possible. Uh, Even with a seller finance note, we try to have it where the note is secured by the business asset you're buying itself. And if property is involved, banks are comfortable that they like property and things there. It's not uncommon that the seller would ask for a note on the buyer's house. I try to stop that because the business should be worth what that note is. Um, and I'm getting ready to buy a business, risk my life savings, and I go home and tell my wife that we're getting ready to risk our life savings to buy a business. She doesn't pay too much attention to it getting closer to closing. Then happens one night to look at the tax return and see the business didn't make any money. She said, "Oh my God, my husband's lost his mind. We're getting ready to buy a business that doesn't make any money based on these tax returns." So, of course, he says he's had my course, so he understands what he's doing. She says, "I'm calling Daddy." And her daddy never liked you very much anyway. So that can cause a huge problem right in our due diligence thing. So if we can, we want the security for the note to be the business assets themselves. You think about it, if I'm paying you $400,000 for this and I put 200 down or whatever that number is, the business sure ought to be worth $200,000 for the security and a personal signature. Because from a practical standpoint, very seldom are you going to get somebody's house. If you got a practical standpoint, if they get in real trouble with the business, unfortunately and tragically, probably file bankruptcy, which means you're not going to get paid. And you don't want that to happen. You want the buyer to be successful and that means the seller's going to get paid. And you want the seller to be successful, they can go ahead and retire or whatever it is. They may be going into another business. Whatever they're doing, we can help them accommodate that. But almost always we do better if we build an honest and good relationship between the buyer and the seller. And to me, that's the one big difference between us and real estate. Is I want to end up with a good relationship between the buyer and the seller. If we do that, we normally gonna have a successful transaction, and it works for buyer and seller, works for us.
Like, give a few more questions in. Just a lot of good questions coming in still. Ed, can you share how to negotiate the indemnity, escrow, and small business transactions?
All right, now I'm sorry, a little hard of hearing. Ask me that again.
Can you share how to negotiate the indemnity, escrow, and small business transactions?
Well, in a small business, usually if you use an escrow, you're talking about using an escrow attorney or an escrow
Yep.
agency. Yeah, they put together the asset purchase agreement, whatever document, notes, security agreements, uh, collect, put in an exhibit of the inventory, put in exhibits of furniture, fixing equipment. Sometimes there's debt in the business that can be taken advantage of, quite frankly. They already got an SBA loan or some balance of a loan due. Don't pay that off at closing. We might can assume that, depending on the funding. Um, but if we can do that, that might lower the borrowing cost that we've got, and we take over that note that's in place rather than having to pay it out. And then whatever precious cash is down payment goes to the seller instead of going to paying the bank off or going to pay that lender off. We'll see.
Excellent. You got a few more in you, Ed?
Yeah.
All right. What are the pros and cons of buying an absentee owner business?
Well, if it works, it was a good idea. And that deal I showed you with that upside down tax return, I mean, that lady, they just hit her up just mercifully. And once people know you don't know your accounting, you don't know how much inventory you got and things. Because one, there was a big discount beer and wine store, and the next 100 cases of Budweiser looked exactly like the last 100 cases of Budweiser. So if you're not on top of the business, you can have some serious losses there, unfortunately, due to having an unscrupulous employee or something that makes a difference that can be harmful. That's the danger of an absentee business. Is like say, so you're not paying attention to business yourself, unless you got some uh, really good financial information. You might say, now listen, a franchise would have you'd be a little more comfortable probably with a franchise because a franchise normally requires an audited financial statement, and they require their franchisees to do this, do this, do this, so you can kind of keep up with that and it allows a little bit more for absentee management, I think, than an independent business.
Great. Okay, so here's a question. What are your thoughts on dry cleaning businesses?
A very good business 10 years ago. I'll tell you what's happened with that. We've sold a lot of dry cleaners over the years. But people don't wear formal clothing as much anymore. I mean, I always wear ties, but I don't go to dry cleaning because all my clothes are drip dry, whatever you call that. That thing, they don't require dry cleaning. And so, depending on your book of business and your customer base, there you may have other clients where you're doing things for hotels and different things like that. That adds to the that. But it has not been more recently as good a business as it was a few years ago, because people aren't wearing as much formal clothing. I call it formal because just stuff that needs dry cleaning after you wear it.
Excellent. Okay, so let's do two more questions. One, what should you do if the seller is optimistic about the current year estimate for valuation? Is it best to take a look at the average of the 3-year tax filed numbers?
Usually the last 3 years are the most important, and sometimes people go 5 years. And sometimes if this year is picked up, if he'll give us an explanation for that, it looks like it's going to continue, we can factor that in to some extent. Or we could even do an earn out or sometimes ways to adjust the thing that if we hit these targets, I'll pay you this much or something like that. Uh, But usually the 3 years will give you some idea of your trend. And the whole saying in this business, the trend is your friend until it ends when it bends. So you don't know. You still have to look at the individual business situation and try to make a common sense assessment. Will this continue this way? It may not continue that much, but if either doesn't hold that much, it's certainly part of the deal. And you might have to have the opportunity to negotiate that in a little bit with some adjustment on your pay you this much, if so and so. If it doesn't happen, I'll pay you this. So we don't just, we try to stay away from earnouts. Earnouts work probably, well, I guess they work for the seller and they work for the buyer if they work. Uh, you want to make sure in an earnout situation you don't have a negative incentive for the buyer not to quite hit some targets, therefore he doesn't have to pay you this whatever that particular earnout agreement is. One suggestion for that we found works a little bit is do a percentage earnout. Even if you hit that target, if you don't quite hit it, you do 93%. You pay out 93% back to the seller. You don't pay, it's not something or nothing. It's not full thing or nothing. That's too punitive. So you can do a percentage of whatever your amount that you hit of that earnout is earned and therefore payable based on the next year's thing, something like that. The um, the other thing with an earnout, well, it's all negotiable, and we've done some earnouts that have there. But another thing with it is the down payment itself, and just what leads up to that earnout, and defining it properly. Uh, and the earnout always should be tied to just gross sales, not to the net. Because guess what? The owner of the business controls the net. Investment tax credit right for the end of the year. I can buy 4 trucks or whatever I need, and gosh, we didn't hit the target this year for the earnout. That's because you bought those 4 trucks thing. So you don't want to end up with a negative relationship there. So it should be tied to gross sales, not a net, not earning, because you don't control the books. After that, as far as the seller is concerned, and a percentage is whatever is earned, you get that percentage. And that way it's a little more fair, I think, and that works.
Excellent. Okay, one last question for our non-US or international buyers. Um, how is it usually perceived when a buyer is coming from abroad, for example, Europe, and plans to actively run the business only after relocating to the US on an E2 visa? Is it realistic to close such a transaction remotely? And how does that typically affect the buyer's negotiating position?
An ET visa is folks moving in here, and I have a great deal of respect for them to come in over here and try to make a living for themselves and their families just like we do. And if they come in the right way, there's been so much bad information about folks. Come in the right way, we welcome them here because you're adding to our economy and you're adding to our country. Those folks are wonderful citizens when they come here from that standpoint. The Usually with an E2 visa, you're going to operate the business. And once you get started and get through in that, if that circumstance changes a little bit, family wise and things, you'd have to adjust that with it. But normally they can, as long as they comply with the visa thing, they're certainly welcome to America.
Excellent. Okay, one last question. I said two. Get your crystal ball out again. What do you think of the future of laundromats?
I think coin operated lenders, they've gone through the downside phase. It's a little bit like we were talking about in dry cleaners. If dry cleaners survive now and this year's few years, you can, based on the fact that they've already made that adjustment. I don't think they're going to take another hit like they've had so far with the circumstance. Coin operated laundry, there are always going to be folks that don't have a wash and dryer in their house and going to need the coin operated laundry. And that's usually a pretty good solid book of business. It's still got to be managed and run right. You have a tendency to think it kind of the management is not as necessary there, but you need to make sure folks respect the equipment and they do, and it's well run and managed and you've got a owner or either an employee though that's there that makes sure it's clean and safe.
Excellent. Well, thank you so much, Ed, for taking your time and sharing your expertise. I really do encourage anyone here with additional questions to give Ed a phone call or shoot him an email or book a meeting. Like I said, he's always available. Thank you, everyone, for attending. We will do more of these, so keep checking your email. Keep a lookout for our insight report. Sign up for Biz Buy Sell Edge, and best of luck in buying a business. It's a great time to do so, and you have resources to help. So I hope everyone has a great rest of their day. And thank you once again.
Thank you very much.